Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time. And this week's topic, guys, is one that is kind of interesting, something you wouldn't expect from me. The topic is called, when is it okay to break your trading plan, right? You guys know me pretty well. I'm hardcore about discipline and money management, etc. So today's topic might throw you for a little bit of a loop. For example, when is it okay to get out of a trade early? When is it okay to possibly take a trade near or at resistance? When is it okay to go against the market trend? The market's going up and you want to short a stock. When are these things okay? The general answer to that is never, right? It's never okay to break your trading plan. Well, today, like I said, I'm going to throw you for a little bit of a loop, and we're going to talk about, are there exceptions to those rules sometimes? Are there things in your plan that maybe you can be a little bit flexible on? Well, you'll have to stick around to find out, all right? I think it's a good lecture because it'll let you not only understand how important your trading plan is, but it'll also leave a little bit of room for recognizing that we're human beings and we do make mistakes sometimes, all right? So, powerful lecture. If you like these videos, guys, please click that like button, hammer that subscribe button, and as always, don't forget those click notifications. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is called, when is it okay to break your trading plan, right? When is it okay to break your trading plan? So for many of you, this would seem like a pretty curious topic for me to bring up. And most of you are probably thinking, well, this is going to be a really short lecture, and you won't be wrong, but we're going to talk about some other things that go outside of what you might be thinking about. Okay, so this lecture, although somewhat unexpected, I think it's necessary, and the reason it's necessary is we're people, right? I mean, we're not robots. We do make mistakes from time to time, and I think it's important that we recognize that and we figure out how and what we can do about it. All right. But before we get into when is it okay to break your trading plan, we must first get into when will the insanity stop. Oh my goodness, these lectures are so great, aren't they? I mean, I feel bad doing these every week, but not enough to take them out of the lectures, right? So I don't feel that bad about it, I guess. This week's is another doozy because people are just, well, stupid, right? So here's a person that's $360,000 SPY puts, right? YOLO. I mean, this person said it themselves. YOLO, down 60K so far. Wish me luck for the open tomorrow. Now, this was a few days ago. This isn't about, and I want to be clear about this, okay? This isn't about whether or not this person gets their hand out of the cookie jar, because it's obvious their hand was or is in the cookie jar, right? $300,000 account that's down $65,000, $64,851.06 to be exact. I mean, that's over 20% of your account. Now, again, this is not a matter of whether or not this works out or doesn't work out. This is irrelevant. Don't care. Okay, maybe the person gets lucky and they make 60 grand. Maybe they don't. But why would you ever expose yourself to 20+% risk in your account on one position? Ever. I mean, think about that for a second. It's just one trade. You're not likely going to get rich on that one trade. I know some of you think you will. It's like buying a Powerball ticket. It's possible. It's just not likely. So why wouldn't you do it the way that all millionaires do it, which is the slow way, right? Take the harder road, the path where each step gets you closer to your goal. You're not looking for like giant, huge leaps here. It doesn't work that way. And this is unfortunately the way many of you come into trading. You come in and you're like, oh, did you see XYZ stock? I'm going to back the truck up and buy all of that. It's just absolutely asinine and absurd. People come in with $10,000 accounts and they're risking $5 grand on their very first trade. Guys, you're not going to get rich quick in this business. Just because you saw some silly asshole idiot online go, oh, I turned 100,000 into 10 million in GameStop, and then it's up to 25 million. Now I'm back down to 3 million. What kind of mentality does it take to do that? A stupid one. Okay, and again, for every one lucky person that makes 100 grand or $1 million or $2 million, how many tens of thousands, if not hundreds of thousands of people got hammered or blew up their account over it? I'm telling you flat out, you're not going to be that person. All right, this isn't, and just to be clear about it, okay, this isn't about dream crushing. You know, people are like, oh, my parents said I would never make it in Hollywood, and ha ha, look at them now. My parents said I would never make it as a musician, ha ha, look at them now. This is completely different. Okay, this is the kind of mistakes and stupidity that will wipe out your entire savings. We've seen it in previous episodes of When Will the Insanity Stop, right? We've seen teachers, school teachers. Now, I don't know about you, unless you're a professor. Everyday school teachers don't make that much money. We've seen school teachers lose $70,000 in their trading accounts. We've seen 22-year-old billionaire kid's son lose $40 and $50 million. We've seen one person borrow $60,000 from his girlfriend's parents and lose all of it. Get your heads out of your asses, man. I mean, you're not going to get rich quick. It's just not going to happen that way. And if you think you're different, then you be the idiot and go try to get rich quick and come back to me and tell me how it works out for you. In fact, don't come back to me. Just don't even bother me with it because I know how the story goes. All right? If you want to do it the right way. Don't be YOLO. There's I don't even have the words for it. All right? You do only live once. So you have an opportunity to live once and do it the right way, or live once and do it the wrong way and be an idiot for the rest of your life. It's up to you. Okay? So, without further ado, let's dig in. I just shake my head at these. Sometimes like it's just too much when you're putting these together and you go, what is wrong with people? But then again, we all know this. Common sense is so uncommon it should be a superpower. And here's the craziest part about common sense. You all think you have it. It's like everybody thinking they're a good driver on the road. You all think you have common sense. I'm here to tell you, newsflash, you don't. Okay? All right, let's move on. When is it okay? When is it okay to break your trading plan? Okay? New topic today. It's just a one-page lecture, and the answer is never. Okay? We're done today. I'm glad you guys showed up for this. I roped you guys in for the last 5 minutes. It's never okay to break your trading plan. Okay? That's it. It's never okay. This is going to be the shortest lecture we've ever had. That's it. We're done for the day. You thought I was kidding. No, I am kidding. There is more to it. All right? There is some more to it. So when we look at trading plans, okay, and being a person, there are times when we might choose to do something outside of our plan. Now, here's the rub, okay, and this is where we're going to have to balance this back and forth, okay, is if it's written down in your plan, you really shouldn't break it. I mean, that's the truth. That's not a joke. You really shouldn't be breaking your trading plan. However, there are times when you're going to make some mistakes. There are times when you might want to make some adjustments to your trading plan. So, for example, when would it be okay to take a trade near resistance or take a trade that's a little bit extended? When would it be okay to go against the trend of the market, right? When would it be okay, to get out of a trade early? Now, some of you guys right now, all the people that are breaking their trading plans are like, I'm going to stick around for this one. I'm getting permission from Jared to get out of a trade early? Oh, tell me more. No, that's not what you're expecting, okay? So the general rule is don't break your plan, but there are going to be certain instances and certain times when you might, let's just say move into the gray area, okay? So the first one we're going to talk about, guys, is taking trades near resistance or trades that are a little bit extended, okay? And I'm doing this because, we did this recently, and some of these, just so you know, some of these are going to merge into each other, meaning there are times when you could take a trade near or at resistance that also goes against the market. Okay. So, Facebook, right? You guys remember Facebook? Wasn't that long ago. It was yesterday, okay? So we saw this wedge on Facebook on the 2-minute chart, okay? And you can see here, right at the 327.50 area, flat top. It had higher low, higher low, higher low, higher low, 4 higher lows on the pivot with a flat top. Yeah, there's a little peekaboo topping tail over here. But this is basically an ascending triangle, right? It's basically what it is, an ascending triangle. So 327.50 was the entry that we called. Stop loss was 326.50, so we had a $1 stop loss. And then you follow this nice, neat little orange line all the way over to the right-hand side. And whoa, wait a second. So on the left-hand side of the chart, we have what we call vacuum trading. Right? We're trading in a vacuum. We're just looking at Facebook and we're like, nice 2-minute chart. That's great. I'm going to take it. But we all know from previous lectures and professional trading strategies that we never trade in vacuums, right? We always use multiple time frames before we get into trade. And the higher time frame bias is usually going to be the 60-minute chart or the daily chart. In this case, we're using the daily chart on Facebook. So you're looking at it going, wait a second. So if we're supposed to use multiple time frame analysis, how in the world would I ever take this trade on Facebook? All right. I mean, you're looking at a stock that had a wide range bar, followed by another wide range bar, followed by a red bar. You could call it a slight resting day, followed by another wide range bar, gaps up, and well, that red line is kind of the area of resistance here. All right. So we took this trade. Right now, it didn't make much money. I think it made $76 on it because it came back to break even. And you can see that right there. It popped in that little peekaboo bottoming tail. Took me out at break even, made just a small amount of money on it. But you sit here and go, well, we wouldn't take this trade, Jared. But maybe we would. And we actually did. Why, though? Why would we take something like this? What would be the reasoning for it? Well, keep an eye on the daily chart because we're going to talk about it again. So keep an eye on the daily chart. We're going to come back to it. This is one of the biggest reasons that I might, can't say always definitely, but that I might take a trade like the Q or like Facebook or Amazon, a FANG stock specifically, okay? If it's showing extreme relative strength, right? And in this case, what did we have yesterday? A gap up in the markets, and they completely rolled over, right? The QQQ gapped up, popped up, and then rolled. Now look at the same thing here. Early on in the morning, guess what? Facebook kind of did the same thing, right? Facebook gapped up and moved higher. Well, the Qs gapped up and moved higher. So the first two bars of the day look similar. Third bar of the day, pretty similar. Fourth bar of the day, pretty similar. Fifth and sixth bars, pretty similar. But this is where Facebook starts to change, right? So if you take the first 6 or 7 bars of the day, market continues to go lower. Or sorry, the first 6 or 7, the market is very similar to Facebook, right? First 6 or 7 bars. But after those 6 or 7 bars, the market continues to go lower. And what does Facebook do? Puts in a wide range engulfing bar and starts to put in higher lows. Goes higher, pivots, goes higher, pivots higher, goes higher. And what's the market doing during this time? It's continuing to go lower. So at this point in time, we're sitting there going, wait a second. Even though they were very similar off the open, Facebook is now exhibiting an extreme amount of strength compared to the market. And where is the market? The market's sitting at support, so the market's likely going to bounce, chops around, and bounces. So if you're ever going to take a trade that might be near resistance, there's 2 things you got to consider. How much room does it have? What does my trading plan say that I'm allowed to do with this? So let me give you an example. My plan allows me to go to break even at 1R. Facebook really didn't have 2R in it, right? Let's go back to the daily chart here for a second. Facebook really only had 1.5R. It had room to about 329-ish, right? And then you're going to start rubbing up into this red line here, okay? Well, if you're doing all or nothing, say 2R all or nothing, and you get into a trade at 327.50 with a $1 stop loss, your target would be what? 329.50, right? $2 on a $1 stop loss for 2 to 1, okay? Well, Facebook didn't really have that room in it. So I don't know that I would have taken Facebook if I was doing all or nothing. But because I was able and allowed to raise my stop loss at 1R, Facebook had 1R in it. So the expectation was maybe we're not going to hit target, but Facebook, I can at least get to break even. So do you see that conundrum there? So this isn't just some blanket statement where you're like, okay, I'm just going to jump in Facebook because it shows relative strength. There had to be a little bit more than that, right? There had to be a little bit of strength there. Okay. All right. Looks like we're out in Eddie's, guys, probably with some slippage with the way that thing came in. That was just dead man walking. But anyway, so in this case, Facebook was a tough trade, but this extreme relative strength is enough to really, really make you consider taking it. It had a nice pattern on the 2-minute. It had about 1.5R worth of room. And this stock ultimately did what? It went 1.5R. It went to 329.18, I believe, and then it came all the way back down. Well, we're in at 327.50. It went $1.68 on a dollar stop. It's 1.7R, 1.68R. Okay? So when you look at that, this might be one of those instances where you take a stock that's up 3 or 4 or 5 days. And normally you wouldn't. But in this scenario, you're going, you know, this stock is very, 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 very strong. Okay? And it's a FANG stock, which means it's normally highly correlated to the market. All right, so find a way in if you find extreme relative strength or extreme relative weakness, but just be careful, especially in this particular case, if a stock is near resistance. Know your expectation, right? Here's another one on Amazon. Okay, here's a trade that we took on Amazon, 32.65 by 32.55. There's the buy setup, lower high, lower high, lower high. All right, doji bar, green bar right there. Gap up on Amazon, gap down on the Qs. So you could make the argument we're going against the market. True, right? Market gaps down, Amazon gaps up. The market also pulled back a little bit. So Amazon moves higher the first 5 bars of the day, 6 bars of the day. The market moves a little higher. Amazon pulls back a little bit with the market, but then it leads the market up. Okay, so here's the rub about this. When you actually look at the picture, there are similarities here, right? Towards the end of the day here, Amazon pulls back. The Qs pull back. All right, they both initially bounce off the open. They both initially pull back. Okay, but when you look at the market was a little bit below support here, but look how much higher Amazon pivoted. The market pivoted at the low of the day or below the low. Amazon pivoted at a 50% retracement point. That's relative strength there. So this would be an example of where you might go against the market because of the sheer relative strength of a stock that's normally related, heavily related to the market, right? So a stock that usually shows a high correlation to the Qs is now gapping up when the market gapped down, immediate relative strength, and showing relative strength after the market opened. Find a way in. Find a way in. These trades have like an 80 or 90% batting average. We rarely lose on FANG stocks that show relative strength or relative weak to the market. I'm going to repeat that because it's important. We rarely ever lose on FANG stocks that show relative strength or relative weakness to the market. Okay? Now, what would be another scenario where you might be able to go against the market? Well, the obvious one, the one you're all thinking about. Climactic type entries, right? You take a look at a stock right here, gaps down to $7.50, drops, chops around, and then just gets hammered. Look at the volume. This is key for those of you. I don't want to get off into some explanation about climactics and parabolics, but many of you have no idea what a parabolic or climactic setup is. You just don't. You think a stock that's down like 2 or 3 wide range bars is parabolic. It's not, okay? It needs to be down 20, 30, 40%. Seriously, I'm not kidding with you. It needs to be down like at least 20%. All right? Maybe not. I mean, at least is a little bit extreme. But you have a stock here that yesterday was at 148. Now it's at 130. That's an $18 move. Okay? So that's not quite 20%. It's more like 12, 13%. But look at the way in which it happened. Look at the volume here on the right-hand side. Look at the volume at the previous day. Look at the volume at the previous day. Now look at the volume today. 4 million shares on one bar? 4 million shares on one bar. Look to the left. This stock's doing 500,000 shares on one bar. This stock doesn't do 500,000 shares per day. Not on an average day does it do 500,000, but today it's doing it on each individual bar. Think about that. This stock is clearly on its own page, right? You don't need the market for this stock to bounce. You don't need the market for this stock over here to bounce. It's on its own page. Does not care about the market, okay? So parabolics and climactics would be another example where you're allowed, you have permission to go against the market trend. If you have a FANG stock that's got crazy relative strength, but the market's gapping down, you would be allowed to go against the market on that. Okay? Be a little bit careful because parabolics are a little bit more reliable when it comes to being on their own page. But these would be 2 examples where you're allowed to go against the market trend, even though we tell you never go against the market trend. Okay? So just make sure it's a genuine and true parabolic, okay? Not some, oh, it's down 50 cents on a $50 stock. That's not parabolic. I mean, your eyes should open wide and go, holy shit, what just happened there, right? Massive volume, super wide range bars. Guys, look at this stock. Just look at the previous day. It traded between 147 and 148.50. 147 and 148.50. Look at the previous day. Pretty much the same. The previous day, pretty much the same. It does $1 to $2 in range. Today, $14, $15 drop. Normal day, $2 in range. Today, $15 drop. Look at this stock over here. Does 30, 40 cents in range. Today, $2.50. 10x normal volume. 10x normal range. Those are parabolics. Okay? Another example, going against the market. Well, in this case, it's a little different because we're actually not going against the market. We're actually going with the market, but against the gap. I'll repeat that. We're actually going with the market, but against the gap. Okay? So remember this is not that long ago, a couple of weeks ago, where I told you guys, the market is going to bounce. The market is going to bounce. The market is going to bounce. The market, I mean, we talked about it all pre-market. I put it out there on all the social media outlets. Market's going to bounce today. Why? It's a mega gap down. The previous day was a red day, and we had a mega gap down. When you're gapping 2% down on the Qs or the SPY or the IWM, and the previous day was red also, you're almost definitely going to do what? You're almost definitely going to go longer, okay? Go higher. Ignore the Facebook, all right? I just happen to have it on this slide, and I apologize. I should have just taken it off the slide. Just ignore the Facebook because I'm not really going to talk about it. It was a different day. But the point is here, we went long on the Qs this day. Why? For all the reasons we just talked about. So this would be an example where you're going against the gap, going kind of against the trend. Now, in professional trading strategy, we do have certain types of gaps where you'll go against the trend, right? You have professional gaps that ultimately change the trend of a stock, and you have novice gaps that gap in the direction of the trend. But sometimes you have a gap so big that it gaps in the direction of the trend, but it's so big it turns around and goes the other direction. That was the Qs a couple weeks ago. So these are all scenarios in which you could kind of buck the trend of the market, so to speak. All right. But this doesn't mean you should necessarily make a habit of doing this all of the time, because parabolics can be challenging to find. The market gapping up or down so big that you expect it to change directions is actually pretty rare. Maybe once a month, maybe a little less than that. Okay. Now, this is what you don't do. All right. This is what you don't do. We talked about some of the things you can do, but this is what you don't do. You have a stock that gapped down, goes lower, so the gap itself is not a problem. Just to repeat, the gap is not a problem. It gaps down and goes lower. But what happens off the open? It gaps down and immediately drops $4. Well, 112 is not exactly an area that you want to be shorting. There's a pivot that bounced. There's a pivot that bounced. There's a gap or a pivot here that bounced. There's a pivot here that bounced. And you're extended into support. So you like the gap, but there were no entries. You think you missed it, so you FOMO and you try to get in under here. And then you lose. Don't do this, is what I'm trying to get at. We gave you a couple answers or reasons why you could take certain trades that did gap down. We gave you a reason on Facebook why you might take a trade slightly into resistance because of the extreme relative strength and the type of management you had. But don't do this. Okay? This stock, if you were able to find a way at 116, that's okay. But by the time you're at 112, there's nothing to do here. Nothing to see here. Move along. Okay? Don't do this. So I put this in there so you guys don't misunderstand what I'm trying to preach today. Okay? All right. Now, get out of a trade early. I had to make a whole slide for this one. Is it ever okay to get out of a trade early? I mean, not really, but there are a couple scenarios. What if you made a genuine mistake? True mistake, not a lie to yourself mistake where you're like, yeah, well, I know I shouldn't have done it, but I did it anyway. And that's not a mistake. You consciously made that decision. That's just being an idiot. Okay? What if you genuinely miss share sized? What if you just over share size? Maybe you're supposed to take 1,000 shares and somehow, for some reason, you took 2,000. Well, you might want to get out of that trade or at least get rid of those 1,000 shares. Okay? What if you got into a stock that was too spready, too whippy, and too thin? What about that? What if genuinely the spread didn't look that big, or you didn't consider or look at the spread, and then you got in and you're like, oh my goodness, look at the size of this spread. Well, you might want to get out of that trade, or you might want to cut your risk back, cut your share size back on that. But it really comes back to this. Was it a genuine mistake, or were you just being an idiot? There's a difference. There is a difference, okay? What if you get filled too late? What if you gave your stop limit too much room? What if you, unfortunately, foolishly used a stop market order, right? What if you used a stop market order to get filled on your trade? Well, that's foolish, right? And maybe you got filled too late. What if you're in a trade and you didn't realize it? This has happened to me before, for sure. You get into a trade and you're like, you trade Exxon Mobil and it's like 10:17 in the morning and you don't realize, like, oh shit, it's Wednesday, 10:30 oil report. Damn, you might want to get out, right? What if you're in a trade all day and it's 1:30, it's 1:45, and FOMC's coming up? Get out. Get out. What if you took a trade 10 minutes before FOMC and didn't realize it? Get out. These would be acceptable reasons to get out of a trade, okay? But they have to be genuine mistakes, things you didn't consider. Or for example, maybe you got into ExxonMobil at 9:45 in the morning and you knew there was an oil report at 10:30 and you were okay with it because you're like, we'll be out of this thing in 20 minutes. And then you're not. And then 10:25 comes around. Get out before the oil report, okay? I bet you most of you don't look at reports, do you? We don't talk about it all that frequently, but I bet you many of you don't look at what reports are coming out. And if you're in certain sectors, those reports are really, really important. They can have a dramatic impact on the stock in which you're trading if it happens to be in the sector of the news report, okay? So let's take a look. I mean, look at some of these spreads. Look at the liquidity or lack of liquidity on these things, guys. You're going to hop into this. Remember, this would be, for example, a short trade at 25.50. Let's say you want to short TSEM at 25.50. I mean, you're going to have a hard time getting filled. What's the point here? What's the point I'm making? The point I'm making is, what if you didn't recognize this spread? What if you didn't recognize the lack of liquidity and you got in this thing at 25.50 and now you're in it and maybe you got filled really late? Or maybe you got in and you didn't realize, wow, this stock's really thin. Why did I take this? Get out. That would be acceptable. But the next question is, how often or how frequently should this be happening? Very, very rarely. I mean, if you're doing your job and you're going through your pre-trade checklist, making these types of mistakes should be a very, very rare thing. 1 out of 100, 2 out of 100? Seriously, no exaggeration. 1 to 2 out of 100. You shouldn't be making big mistakes like this that often. Okay, but it will happen from time to time. Over here, look at this spread, guys. There's a 20-cent spread on a $24 stock. Is that something you want to really mess with? Probably not. I mean, if you have a $1 stop loss, you might mess with it, and maybe this stock's capable of going $2 or $3, perhaps. But these are the types of things you want to generally stay away from, right? You take a look at this right here. Perfect example. Nice consolidation base breakout here at $60. Beautiful, right? Look at 60 bucks. 2,194 shares printed. 7 cents later, 100. 4 more cents later, 200. 681, 100, 200, 200, 200. So what do we have? Over $60, we have 300, we have 981 shares, we have 1,081 shares, we have 1,281 shares, we have 1,481 shares, we have 1,681 shares printed in a 30-cent range. 1,681 shares printed in a 13-cent range. Really? And you're going to take that? It's too thin. It's got 118,000 shares on it. Okay? It's got 118,000 shares. Be mindful of the spread. Be mindful of the liquidity or lack thereof liquidity. Guys, this shit matters. So you may not even have gotten filled. But what if you did get filled? Maybe you get filled up here at 27. Maybe you get filled quickly on the pullback. I don't know. But what if? What if it stops out? Oh, you're in deep shit. Not only does it have a 10-cent spread, it doesn't have any volume. So where are the shares going to come from? Where are the shares going to come from? They're not. So if you got 1,000 shares of this thing or 2,000 shares of this thing, whatever it is, and your stop loss is at 59.50 and this stops out, you're immediately going to take 10-cent slippage because that's the spread. But then there's no liquidity down here. So you're probably going to take 20, 30-cent slippage. Now you've lost an hour and a half for no good reason. Why? It's a trade you shouldn't have taken in the first place. You knew it. You just couldn't lay off it. FOMO. You knew it. You looked at the pattern and you're like, oh my gosh, it's so good. You're biting your finger. And you're like, oh my gosh, I got to take this. What should I do? No. The volume sucks. Don't take it. The spread's too big. The liquidity's terrible. Stay away. Stay away. All right? Same here. Look at this. Right here, 1665 is the entry. All the shares printed at 1666. So here's the rub on this one. If you didn't put your order at 1665 or 1666, if you didn't do that, let's say you put it at 1664, there's a good chance you're going to get filled at 1655 because that's the next area where a lot of shares showed up. Well, you only have a 25-cent stop loss. I'm not probably going to give it a 10-cent stop limit. So if you got filled 10 cents late on a 25-cent stop loss, that's 40%. Now what? Now you have 40% too much risk. So now you either have to get out of some shares, and in this case it looks like you could have, or you have to lower your stop loss. Right? So you have to reconcile that. It's okay to try to get in this. It's got plenty of volume, but maybe you got filled really late because you gave it a little too much room. We need to reconcile the money management. Okay? Another example. Look at the spreads here. It's a 34-cent spread. Look at the lack of liquidity. ZM over here. It's a 20-some cent spread. Look at the lack of liquidity. If you're going to short this stock at 97.50, there's nothing below it. Nothing below it. Okay? Now, it's rhetorical. You don't have to answer. How many of you do this shit all the time? I bet you there's people in here that do this almost every day. Every other day. You take a trade, you can't lay off it because the FOMO. Oh, but the pattern's so nice. I know the spread's 50 cents and the stop loss is only $1, but I just can't lay off it. And then what do? When it wins, you type it into the chat room and I hammer you for it and you think it's sour grapes for me. Literally, you think it's sour grapes. It's not. I'm trying to help you. Because when they don't work, and for example, when Adobe peekaboos over 270 right here, just peekaboos over to 270.05 and flashes right back down, and you take 37-cent slippage on it, on a 75-cent stop, and you get pissed off, it's your own fault. It's your own fault. You knew going in it was too thin. Don't do it. What you're supposed to be doing on trades looks like this. That's what a great trade looks like. This should still encompass the vast majority of your trades. Gap down, we start with the daily. Gaps down under a bottoming tail pivot. Has room all the way down to $55. Yeah, there's a rising 200 there, but again, plenty of room to trade into that area. Okay, good $4 to trade into it. 60-minute chart. See the red line right there? It's gapping under it. There's your room on the 60-minute, your tradable void on the 60, which is still above the 200. You get a beautiful pattern on the 1-minute chart right at 62.50. Get in at 62.50, your stop 62.70, and just grind it all the way down. In this case, to like $60.70, something like that. $1.70 on a 20-cent stop, 8 to 1, 8.5 to 1. This is what most of your trades should look like. You need to be staying away from this garbage. Right? You need to be staying away from this stuff. I understand what it's like. You're out there scanning, or the gap list only has 3 stocks on it, and you're like, oh man, there's nothing to trade today. So you look at Adobe or you look at ZM, and they have a nice pattern, but they have a spread that's ridiculous. And then what happens sometimes? Those stocks hit and run. DKS is a great example of that. Right? DKS is a great example of that. It didn't have a pattern off the open. The spread at one point was $2 on DKS today. $2 spread at one point. You can't take it. Plain and simple. What DKS do? It only went up $7 today. Wink, wink, sarcasm. It did. It went up a ton. A trade that was my favorite stock today on the gap list. We talked about it. It was my favorite stock today. Hit and ran. Nothing I can do with it. Oh, well. I'm not taking a stock with a $2 spread. Maybe Amazon, if it had, even Amazon with a $2 spread is too much. You're going to take a $100 stock, a $90 stock with a $2 spread? No thanks. No thanks. You need a $6 stop loss. Where's your risk to reward there? It's not. It doesn't exist. And then worse yet, you short it. My goodness. But the point simply is, be smart. Live to fight another day. All right? Don't try to get rich quick. No YOLO, no FOMO, none of that crap, man. Look, I could probably talk for hours on this particular topic. We'll go outside of trading to bring it back inside of trading. Technical analysis trading is a systematic way to make money using candlestick charts. And the only way you're going to do that is one chart, one trade at a time. Okay, you're not going to take one trade that makes you $1 million or $100,000. It just doesn't work like that. Hit singles, doubles, triples. Once in a while you hit a home run. But a home run is not retirement money. That's not trading. That's investing. Okay? If you want to do a little YOLO with $1,000 on something, fine. Whatever. No big thing. But don't be an idiot. Oh, yeah, I put 50% of my account in that. Why? Why would you do that? Okay? And AK, I don't know what to tell you, man. Down $3,100 at one point. I have no idea what your risk level is, but it certainly sounds like it's a lot less than $3,100, but you stayed in it. I mean, that's about the dumbest thing I've heard all day. And I'm not trying to be mean. I'm just telling you, that's the dumbest thing I've seen all day. No, I mean it. Like, you can call it rude, but where's your common sense? Remember earlier today when we talked about how you all think you have common sense, and I said, wait, you don't? Perfect example. Somebody proved me right already. Didn't even have to take that long. I'm proven right every day I get in my car and drive down the street that common sense is. Every day I see people out there wearing those, whatever they call them, on their faces. I don't see, a lot of lack of common sense. Point is, you're not going to get rich quick. If you're going to make money in anything in life, especially trading, you're going to do it the slow way. You're going to grind it out. The first year, if you make a little bit of money or break even, you did great. Second or third year, you make a little bit of money, good. You're not going to make big money for years at this. Period. So why do you think you're going to do it in trading when you can't do it anywhere else in life? Think about what I just said, and I'm going to end on that topic. You work for a boss, you work at a company. You didn't get rich quick doing that. Why do you think trading is going to be different? It won't be. All right? So today's topic, guys, when it's acceptable to break your trading plan. Well, there are certain instances when it is acceptable. For example, when you've made a genuine mistake. For example, you might be able to take trades that you normally wouldn't take that are up 3 or 4 days in a row. If they're showing extreme strength to the market, they have not exceeded their average trading range, and maybe you can still get 1 or 2 R out of it. Okay? So there are certain circumstances, not many, where it might be okay to push the envelope, push those rules just a little bit, but you have to have really good reason for it. All right, so I hope you guys enjoyed that lecture. I'm Jared Wesley. We'll get back at it again next week.